Hey, everybody. Although this is called the October market update, the data is up until the end of September 30th of last month. That being said, you'll see that there's some volatility of late. There's an election coming up next week. I'm getting a lot of questions. Should we do anything? And right now, I'm a firm believer of you don't make knee-jerk decisions. If you want to conduct yourself in an orderly fashion and make informed decisions and informed strategies, I'm all about that. And that's part of what a good financial advisor does and brings to the table is it helps you to manage emotions. So you see the theme spooky, right? I mean, fear is an emotion, and we can sometimes let and get run away with that. So we have to just say, hey, logically speaking, what has really changed and what should we be doing, if anything? And there's a consensus out there that typically most emotional decisions in the past, when they've done surveys, have actually been incorrect. So the first section that we're going to get into for the market update for 2020, if you've not seen these slides before, the first three slides will be on the equities market. And the second three slides will be on the income generating type markets, right? So there's a graph here, and this is for, like I said, it's labeled October, but you'll see it ends on September 30th. So this is the data for the month of September. And as you can see across a broad spectrum of indices that actually overall, both the world economy and US economy had a negative month. So, that's with an election coming up, with COVID spikes coming up, that's not surprising. But on the right side of the screen, we'll go over the color codings and what they are. And the least volatile area was this bright pink line. So this bright pink line is emerging markets. China is including in that, and they lost the least amount. So if you feel that some of your portfolio should hold China or emerging market type growth vehicles, then this would support that decision, but it still lost money. The next one is a bright green, and this is developed markets, right? So this is typically your European markets in developed countries. It lost a little bit less. Black is real estate, right? So REITs and things like that nature. Then we have a dark blue line, which is Russell 2000, which is small caps and small businesses. And again, we're in a COVID environment. A lot of businesses are struggling. That is not surprising. Down this month, after having a pretty good run, was the S&P, right? So, large caps, this is a, market weighted index, and it's been run by technologies is typically the top five holdings, right? Your Facebooks, your Googles, your Amazons we're keeping that at very high altitudes, but it had a little bit of a pullback this month. The next two were gold. Gold started to see a little bit of a downward pressure but you'll see on the next slide that it's actually been a pretty good decision long term for this year. And then the light blue is commodities, right? And commodities are predominantly made up of the oil and the oil sectors. And it's not surprising that oil has just been getting beaten up with, the cruise line industries, the airline industries, just an abundance of crude oil out there, and in limited places to store it has put it under pressure. So this was a month to date, so September, and then year to date. Now, year to date paints a little bit different picture. So again, if you haven't seen this, right, that teal line at the top at almost 25% since the beginning of the year is gold. And that is typically a sign when investors for a flight to safety. So this supports that data. It's off its highs, which were in August. Even though the month itself, September, was off, it still has performed pretty well. The next one down, though, and again, the US, my philosophy, and Warren Buffett has said this before, don't bet against the US, right? So, over time, we might have some hiccups, but we always rebound. So large caps, when you look at where we were in February and the fall off into March to where we are now in the recovery, it just shows you the resiliency of the US market. But one of the reasons I point out that when we're investing and you look on the market and you go, oh, the market's back, or we're at all-time highs, or the market had a sell-off yesterday, 9 times out of 10, when you look at your portfolio, you're not in just one of these indices. You're in a combination of indices and strategies. So keep that in mind. You have to take the information that we're hearing on TV with a grain of salt. I always say this, and that is that the TV stations, the news channels, they must create news somehow, way, shape, or form. And whether that's with the appearance of fear, or the appearance of a bull market, or tragedy or weather or something to talk about. It's very, very common to get a myopic view of something when in fact we probably have a more diversified portfolio, which explains why we don't lose as much when it goes down, but we don't gain it back as quickly. So just temper the information that you're getting so that it makes sense to you. Now, finally, emerging markets, even though it had a good month last month, is just about breaking even for the year. Now, just below that, that's developed markets. And this is reflective of, like I said, European countries, developed countries that are still dealing with COVID. Their economies have not come back. They're still overall down for the year. And then you have the next one, which is the small caps. And again, this just sort of supports what we know intuitively and logically, and that is that the small caps, the small business owners, your local restaurants, your local hardware stores, your local tradesmen, their businesses are down, right? I think construction, that's the one area where if you're trying to get an electrician, a plumber, HVAC person, those guys, I think, are busier than they've been in a long time. And that's because a lot of people are staying home and things are being broken and they want to get it fixed, and you can't get a return phone call. I know my father-in-law is dealing with that right now with the project he's going on, and I dealt with it over the summer. But when I talk about smaller businesses, this is just, small to mid-sized cap businesses where revenue has dried up. And because they have, and they're trying to cycle through, how they have employees come in, how they're actually servicing their client base. It's a challenging arena. And I think that overall that would be, logical to expect that kind of downward pressure for the year. Again, REITs, that's the other thing I've noticed in the last 2 or 3 months, because again, I do college planning. Quite often folks will have investment real estate, or they'll say, hey, I'm going to take some money and I'm going to buy an investment property near a highly desired campus, and I'm going to make a windfall money. And that's my decision. And I listen, it's folks' money, but I always caution you, you really want to look at it from a completely 360-degree view. Real estate investing is not all it's cracked up to be. Because once you check in, it's very difficult to check out. I got a client of mine that's been trying to sell 44 acres in Virginia for close to 5 years and cannot get out of it. But it seemed like a good thing at the time. If you buy a house, now you're going to be a landlord. And do you want to be a landlord when you're 75, 80, right? REITs. David Lerner in New Jersey for years was promoting REITs, REITs, REITs. And a lot of people checked in and they sounded good. Look at the income stream they can throw off. And now folks can't get out of them because they didn't read the fine print. So just be careful what you wish for. Real estate, well thought out, can be a performing asset, but I don't think you're going to see some of the growth rates that you expect. Maybe an income stream, but not necessarily the increase of the asset. And then lastly, you see commodities. That bright blue line at the bottom, it just got pummeled. Oil is just, predominantly the major holding in this sector, and it's just oil and anything with the commodities right now. You've lost your shirt, and do you sell? Do you get out? Is it going to come back? It's just an area that we tend to stay away from. So now this is a chart. There's a lot going on here. If you've not seen it before, from left to right, I'm going to explain it. You have vertical lines, right? Red, green, red, green, red, green. And then you have from top to bottom, you have three sort of indicators. You have your relative strength index, RSI. Then you have your moving average, right? So this is a moving average crossover is the middle one. And then you have your last one is your MACD, is your moving average convergence divergence. And these are technical indicators, which, we call this the three wise men. And really it's not proven, it's not absolute. There's been head fakes, but it is an indicator that we and our investment managers will look at to get a pulse on what direction seems to be happening in the market? What are the headwinds telling us, or what are the tailwinds telling us? So as you can see here, all the way to the left, when 2000 happened, that means that all three of these indicators went red, went negative. And when that happens, that would be a sell signal for a lot of our money managers to move to cash, right? And you could see that this was accurate. And then for 3 years, it went down. But then the green indicator here was when all three of them went positive. It means that we should be on a bull run. So that explained the next few years. But you see in 2008, 2006, 2009, you had a little bit of a head fake there, very similar to what we had happen in March. So, we had the sell signals, right? And a lot of our indicators said, hey, let's move to cash. And, for a lot of my clients, I sent out an email and said, hey, listen, you know what, as much as the indicators said, the economists and the CFAs and the money managers that I talk to are saying that this is, because of COVID, it was it's freak, and give your clients the opportunity. So we sent out an email, and a lot of our clients elected to follow our advice. And hey, listen, you can sit on the sideline and wait, and then finally, just in August, so from March to August, the three indicators went green again. It's just saying the only thing that's on the horizon that is, there's two major things that can cause concern, but there's nothing like overly panic button, right? But that would be COVID, and that would be an election, right? Will cause volatility. We have a lot of that going on right now. So, we're constantly monitoring the markets, and these are indicators on the equities. Now we're going to go over the same thing on the income riders. Now, the income rider, this tells a little bit different story because, last month we were actually down for all the income markets. So, the top one is this blue one, and then the next one is the pink one. And both of these are, the top three. You have your 20-year treasury bonds, you have your 7 to 10-year bonds, and then you have international bonds. So these top three were places that increased value. But now if you start to go down, you start to get into these areas that are, close to zero. So the black are muni bonds, and then the teal under that are high yield muni bonds. And then you see the US aggregate bonds. So they're all hovering. There's not really anything that's saying, oh my God, we're making money. And then obviously you have the high yield corporate bonds was the most risky, least performing asset on a monthly basis. But when we take a more of a macro view and zoom out, well, how are income producing vehicles faring? Well, again, at the top of the charts are your 20-year and your 7-year long-term treasury bonds, treasury bills. So, that makes sense because that sort of mirrors what gold has been. So there's a sentiment amongst investors, a flight to safety, looking for things where we can't lose money, right? In their mind. Now, I say that term because that is a belief system that quite often investors believe. You can't lose money in gold, can't lose money in treasuries, can't lose money in both mid and long-term treasury bonds or bills, and that is inaccurate. You can lose money in anything that is considered an investment. But now what is the yield? But right now, year to date, they are up, and some of them are in excess of double digits, even 20%. So, if you had a crystal ball and you knew you wanted to be in 20-year treasuries, you could have made some money, but nobody knew, back in January that COVID was going to hit. We further on down the scale, and you see again, now the US aggregate bonds, they're up around 5-6%. And then we get into the pink line and the blue lines. And then ultimately that last one is the high yield munis. The two areas that got beat up early in the year in the COVID, all the bonds pretty much took a dip, but it's really the muni bonds that have been digging out of a hole for the rest of the year. They're still not into zero or positive territory, but they have recovered quite a bit. So think about it, muni bonds, which are quite often touted as safe havens and tax friendly vehicles, you really got to to dial in on that language to say, what is the risk of these, right? Is there risk of both municipalities and state bonds defaulting? And it's happened in the past, and they do become risky assets, especially when they're losing money. You put money into an account and you're told, hey, it's going to yield X, but then you turn around and you find out, yeah, maybe it yielded X, but now it turned around and went down in value. And that's because you can't sell it to anybody at the same price you bought it. That's where the reality starts to come into focus. All right. So again, the bull bear indicator, again, we have been on a bull run. I say a 30-year bull bond market run. And you see here the same indicator. So you have your RSI, you have your moving average, and you have your MACD. But the last line we have was a green line, right? And so as this bond market has been running since, probably October of 2019, we've been on an upward trend. However, you're starting to see this crossover point. We may see some triggers for bond areas here in the near future. I don't have a crystal ball, but I do see signs here that these are starting to look like they want to start to touch and maybe even cross over. So it will be something that it'll be interesting to see how October fares after the end of the month, and then November obviously with the election. So that's our update on the equities and on income generating assets. Lastly is a proprietary economic outlook probability indicator. Basically, it's a recession probability analytical tool. And what this does is it might take 20 or 30 different data points, housing market starts, gross national product, just any number of factors that are associated, whether it's the travel industry or oil, anything to say, hey, that 50% line is the median. And, if it's above the 50, right? And that hit that back when we were going over this in April, May, and June, we were above the 50 percentile, started to say that, hey, listen, a recession looks like it could be on the horizon. And then anything below the 50 means that, storm clouds are starting to move away. Right now, you can see how quickly in February it started to spike up. And you can also see how quickly in May, where it looked like we might be heading towards a recession, things started to tail back. So we're watching this closely. We'll continue to monitor it every month. But it is something, I think it's a unique proprietary indicator just to give us a pulse check of the economy, right? So the last thing is, from my family to yours, we want to wish you a happy Halloween. From our families to yours, stay safe. If you need us, reach out. And if the advisor that invited you on the call today, if you have any questions, please reach out to them as well. Thank you. Have a great day, and God bless.